Monica Robey, and I'm from the Transaction Support Centre, a housing advice office based in Khayelitsha, Cape Town. We're so excited to be part of this year's Money Smart Week, and thank you so much for including us in this year's lineup. So your house is likely to be the most valuable asset you ever own. So looking after that asset and making sure it accumulates in value and wealth for you, your household, and the South African economy at large is one of our core missions at the Transaction Support Centre. So today, the topic of our video and presentation is all around financing your first house with a mortgage loan and something called the FLISP subsidy. I'm going to be talking through 5 main questions. First of all, what is a mortgage loan? And what do lenders look for when granting applicants a mortgage loan? Then we're going to be talking about the FLISP subsidy and who qualifies for it, as well as how to apply for the subsidy. Okay, so to start, what is a mortgage loan? A mortgage loan is a loan from a bank or other lender for the purposes of purchasing a property or building a property. The client and lender enter into loan agreements so that the lender provides the money to purchase the property upfront, and the client agrees to repay that amount of money over an agreed period of time. Usually this is 20 years, but it can go up to 30 years. But this is also a period of time that you can discuss with your lender. The bank or other lender then charges an interest rate, and that is to compensate them for lending you the money upfront to buy your property. This rate varies depending on a number of factors and also varies from bank to bank, which is why it's so important to shop around for the best rate possible. A bond is registered against the property when you get a mortgage loan, and this acts as a security for the lender in the event that the borrower doesn't pay back the loan or the money to them. The lender then also retains the original title deed for that property up until the loan is paid off. Effectively, that property is still owned by the bank or the lender up until the time that you make your final payment. So again, in the event that the borrower defaults on the mortgage loan, as in doesn't make their monthly repayment for a number of months, the lender may be forced to repossess that property to recover the amount that they are owed. So qualifying for a mortgage, what do lenders typically look for? So some of the key factors include your employment record. Lenders like to look for regular, stable income flows from verifiable sources and will often ask for 3 to 6 months of salary slips to prove this. They also look for a good credit score and history. So lenders will look at something called your credit report, which is pulled from the credit bureau, to understand what type of borrower you are or that they are lending to. So they will look for things like, do you pay off your accounts in time? Have you ever been blacklisted or had any judgments made against you? This is why it's absolutely critical to honor all your debt agreements to maintain a good credit score and a history. The third thing that lenders will look for is proof of affordability. So that is basically asking, does this applicant have enough disposable income to cover the mortgage repayments? And a usual rule of thumb in the industry is that housing repayments should not exceed 30% of your total monthly household income. So using a very basic example, if a borrower earns 10,000 Rand total monthly household income per month, the mortgage repayment should not exceed 3,000 Rand per month. And the last thing that lenders will look for is the valuation and the condition of the property. So lenders will actually send a valuer out to the property to inspect it, and they will look for things like serious flaws in the structure of the property and any other issues that may impact the property over time or the value of the property over time. So this might include, I mentioned, structural issues. It might also include unplanned building extensions or even illegal electricity connections. So now let's focus on what is the FLISP subsidy. The Finance-Linked Individual Subsidy Program is a government housing program that is designed to make first-time home ownership more accessible and affordable for individuals who fall into what is known as the gap markets. These are individuals who earn too much to qualify for an RDB house, but not quite enough to get a mortgage loan from a bank. As I mentioned, FLISP stands for Finance Linked, and that is because it is meant to help reduce the size of the mortgage that individuals need or to make those mortgage repayments more affordable. So what is the subsidy amount? This is based on a sliding scale based on how much the applicant earns. So at the bottom of my screen, you can see I've got two scales there, the monthly household income and the subsidy amount. So individuals at the lower end of the scale, earning R3,501, qualify for a FLISP subsidy of R121,626. And individuals on the upper end of the subsidy scale, earning R22,000, qualify for a subsidy of just under R28,000. So how does the FLISP enable affordability and access to property ownership? Here on my screen, I'm showing you a bar chart. And first, I want you to look at the first bar chart, which at the bottom shows the monthly household income of applicants, and along the side shows the maximum house price that those applicants could afford to purchase. So an individual with an income, a gross monthly household income of R7,500 would qualify for a mortgage of $157,000, around that amount, from a bank. That is the maximum amount that they could earn. So you can see with the FLISP subsidy, which they qualify for, which is just over R100,000, that now means that they can afford a house to purchase of up to R230,000 or R240,000. So you can see there, the FLISP subsidy is highly contributing to the affordability and access to property ownership for these individuals. Likewise, if someone was earning around R10,000 a month, the maximum mortgage that they could qualify for from a bank is around R280,000. They could also get a FLISP of about R88,000, and that then boosts the type of house that they can afford to buy of around R380,000. Okay, so who qualifies for the FLISP? I've mentioned the household income criteria, which is individuals that earn between R3,501 and up to a maximum of R22,000 per month. The other criteria includes that you must be a South African citizen or permanent resident. You must be married or living with a long-term partner, or single but with financial dependents. So these may be children or grandchildren, but anyone that you are primarily responsible for looking after the expenses. The FLISP is only available to people who have never owned property before. As I mentioned, it's to help enable access to home ownership for first-time home owners. The other criteria is that you may never have benefited from a housing subsidy before. So if you've already received an RDP property, unfortunately you do not qualify for another subsidy in the form of a FLISP. And lastly, as I mentioned earlier, you must have qualified for a mortgage loan. So if you don't unfortunately qualify for a mortgage for one or other reason, perhaps your credit score is not good enough, then unfortunately you can't access the FLISP. Okay, and then lastly, so how does one apply for the FLISP? So this varies between provinces, but generally you can contact your Human Settlements Department, your Provincial Human Settlements Department, or the National Housing Finance Corporation to get the application forms and more information about how you might go about applying for this. The Transaction Support Centre can also assist those who are buying property in the Western Cape or Cape Town specifically. That is all from me today. I hope that you found this information highly valuable and interesting, and thank you so much for your time. If you need any questions or queries, you may contact us on our details, which are now up on the screen. Thank you again.